Good morning, good afternoon, everyone. We are so excited to have you here today with us on our first edition of ARIVE Partner Spotlight. ARIVE Partner Spotlight will be a monthly series that we will be hosting, where we will talk about topics which are relevant today. We'll talk about things which can help you grow and win more business. ARIVE Partner Spotlight will feature ARIVE partners, as the name suggests. And we are really fortunate to have with us two experts from Newrez Wholesale and PRMG. Newrez and PRMG have been ARIVE partners for a really, really long time, and I greatly appreciate their support. Today's topic is temporary buydowns. So we will talk everything about buydowns today. If you have any questions, feel free to use Q&A tab at the bottom of your webinar. So we will be taking questions at the end. And with this, I would like to introduce our host for today's webinar, Amy Hulett. Amy started with ARIVE as a Director of Business Development, and she has been in the mortgage industry for more than 20 years. So without further ado, Amy, do you want to kick this off?
Yes, thank you, Harish. As he said, my name is Amy Hulett. I joined ARIVE recently, and having quite a few years in wholesale lending, I'm very personally passionate about this series and being able to connect our ARIVE mortgage brokers with our integrated lenders so they can share information about what's going on in our industry, products, niches, how they apply in your market. And so today we're launching this series. I hope you join us every month as we showcase our lenders going forward. So today we have Cory from PRMG and Chris. Would you please like to introduce yourselves a little bit? If you can start with yourself, Cory, and just tell us a little bit about you.
Of course. Thank you guys for having me. My name is Cory Przelicki. I'm the Southeast Regional Manager for PRMG. I've been doing wholesale for 19 plus years, and I'm very passionate about the wholesale channel and helping brokers grow their business and live that entrepreneurial spirit. So very excited to be here with you guys.
Thank you. And Chris, please tell us about yourself.
Absolutely. Yeah, my name's Chris Mozilo. I've been with originally Caliber, and we got acquired about a little over a year ago by Newrez. So I've been with them for 7 years. So Newrez Wholesale, I am the divisional vice president covering the West. And, we're really excited about our partnership with ARIVE. We got with ARIVE from the very beginning and seen it grow and change and advance and become an amazing tool. So we're very proud partners of ARIVE.
Thank you so much. We're so glad to have you here and appreciate your support for our mortgage brokers and our ARIVE family. So our topic today is buydowns. It's a hot topic in the market, temporary buydowns to be specific. And so we have prepared some questions that we're going to ask our experts about so that they can share everything there is to know. And we'll also have some time at the end for some questions. So if you do have any questions along the way, please feel free to drop them in the chat box. We'll be monitoring those and we will address those at the very end. So please participate. We love that you're here. We want to hear everything that you have questions about. So our first topic, Harish, if you can bring us to our questions. Our first topic is geared toward Cory. And Harish, are you able to share our slide?
Are you seeing my slides or no?
I just see us.
Okay, so let me do one more.
No problem. It's an easy question though, Cory.
Yeah, it is.
There's not a lot.
He brings it up, we could just ask it.
Yeah, if we just want to go in. Okay, Cory,
what is a temporary buydown?
Yeah, what is a temporary buydown? If you could walk us through, that would be great.
Yeah, it's exactly like it sounds. So temporary buydown is a reduced rate for a period of time. So just like the name calls, if you see a 3-2-1, that means the very first year is going to be the note rate minus 3%. Second year's note rate -2. The last year's the note rate -1, and then by the fourth year, you're on to the normal note rate. So that is, basically it in simple terms, but it's just like the name calls. It is a temporary buy down of the rate.
Perfect. Thank you. Okay, our next question is, why are buy downs popular now in this market, and what are the benefits to borrowers? Chris, would you be able to answer this for
I
us?
would, yes, and I love answering this one because a lot of people think, especially because we haven't done buy downs in so long, they think buy downs are new, and there's actually nothing new about buy downs. Essentially, what buy downs are kind of this old toy that we forgot we had that's was in the back of the closet, and we were thinking about the market that we were in, where we're kind of shifting from a seller's market to a buyer's market, and prices were starting to soften a little bit, and sellers were much more anxious and willing to provide larger concessions to get their home sold. And we realized, oh, wait a minute, we've got these buy downs, they're back on a top shelf in the back of the closet collecting dust, and we have these products and we haven't used them in a long time, and maybe we need to update our technology a little bit in our LOS software to make way for these products. But these products are popular now because of the market that we're in, right? We were in an appreciating market for a long time, and it's just a product that hasn't been used in probably a couple decades. I remember doing these when I first got into the business in the 90s. At different times, these were popular. And essentially what it is and what some of the benefits are is that the seller is essentially paying a portion of the home buyer's mortgage at closing. So the seller is making a concession, and they're going to put a pile of money that is going to be the buyers, and we'll talk about the importance of that piece, right? They're not just paying a fee; they're putting aside some money for the buyer that's going to subsidize that home buyer's payment for 1, 2, or 3 years, as Cory was just describing. And we've also got an example a little bit later on that we'll show that this really is a better alternative than simply doing a dollar for dollar price reduction. And I think real estate agents have had previously just kind of been used to, hey, we'll negotiate, and it will be all about coming up with the right price, maybe reducing the price as we're more into the buyer's market now. But maybe we'll pay a discount point or something like that. And now they're recognizing how, wait a minute, these buy downs, these temporary buy downs, and creating a seller concession as part of the purchase contract for a buy down is actually a really powerful thing. And actually, here's the example. Thanks for pulling that up. Here's an example, and this corresponds with a specific buy down scenario. That's a 2-1 buy down. So in this particular scenario, it was a $500,000 mortgage at 6.5% note rate. And yeah, there's a calculator a little bit later on that we'll go over when we talk about how you calculate the cost of a buy down. But here, if you were to compare in the first example, hey, instead of doing a 2-1 buy down on a $500,000 loan, which costs roughly $11,000, let's just do an $11,000 price reduction. And that's the same exact amount to the seller. So it doesn't matter to the seller which example you use, they still net the same amount at closing at the end of the process. So if you do that, your loan amount goes down a little bit, right? Because your sales price went down, and your P&I payment, instead of being $3,160 a month, ends up being $3,100 a month. So saving $60 per month by reducing the sales price by $11,000. Instead, if you took that $11,000, didn't reduce the sales price, and did a 2-1 buy down instead, you'd keep the loan amount at $500,000. The first year, you reduce the payment or the interest rate by 2%. So now instead of 6.5% as the note rate is, the buyer's paying 4.5%, which saves them $626 per month in that first year. The second year, instead of 6.5%, the note rate, they're paying 5.5%. In that second year, they save $321 dollars per month. So that $11,000 that they're saving in that first year with those lower payments, in the first example, if they just reduce the price and save $60 per month, it would actually take them 15 years to have that same amount of savings that they're having in 2 years with the 2-1 buy down. So you can see there in that example, just getting a little bit more creative and doing a temporary buy down, in this case, a 2-1 buy down, is much more powerful for the buyer, and the same result for the seller.
Right. No, that's a great illustration and pretty powerful for buyers to be able to see their monthly savings versus like, hey, I got a deal and they reduced the sales price by X. I mean, it does matter in your pocket every month in this environment. That's what buyers care about. They're scared about their payment right now. And so this gives them a great option to feel more comfortable. So thank you for sharing that. Okay, so our next question is geared toward Cory. Cory, what programs and scenarios qualify under temporary buy downs?
Yeah, so most major programs, conventional, Fannie Mae, Freddie Mac, government loans, FHA, VA, USDA, even non-QM products qualify. There are some particulars when you get with each lender, so obviously go check with them, but obviously it has to be a purchase because seller contributions are a must to make this work. Fixed rate products only, and it's got to be a primary residence. So those are the main boxes that you need to check. But yeah, definitely check with any specific lender that you're using. And Chris, that was a great example of what you just showed as well. In fact, you showed the 2-1 buy down, and I just wanted to kind of add this to what you said. You're going to see all different variations of buy downs: 3-2-1, 2-1. There's a 1, maybe 1-0. I think Chris has even talked about getting in some half points. So all of it works the same. It's just the different variations of what's going to be reduced off the buy down when you see the different variations. But the way the program works is actually the same.
Fantastic. So the messages that I'm getting is purchase only, seller paid, and to really work with your individual lender to make sure that you're meeting their requirements, but that there are some outside the box scenarios that may work too, including non-QM. So reach out to PRMG and Newrez for info on that.
Can I add just one thing to that? Because we do get this question about qualification. I do see a bullet there about qualification. You have to qualify at the note rate, which is the final rate. Just that's an important note, right? If you're doing 6.5% as your note rate and you're doing the 2-1 buy down, like in the example we showed, you got to qualify at 6.5%. There's ability to repay rules. So this is not something we're gonna, where you're using a buy down to help someone qualify per se. You're using it, still the qualifying at the note rate, but using it to make them maybe just get a benefit of a lower interest rate for those first year, 2 years, or 3 years.
Great point. Thank you, Chris, for pointing that out.
And
Okay.
how about the documents, Cory, like the loan estimate and the closing disclosures and underwriting? Does any of that change? What is your experience?
Yeah, well, it's all going to show up under Section H on the LE and the CD. You're not going to actually see the buy down amount. That's what Chris was just alluding to. You're still going to see the full note rate with the full payment. When they close, there is going to be an addendum that they sign that's going to detail the terms of this custodial account that's going to be made on the borrower's behalf, and then that's where that money is going to go. And then each payment, each subsequent month, they're going to allocate those funds from that custodial account to make the payment less. And that's basically how it all works. But yeah, on the LE and the CD, you're going to see it under Section H, which is going to show the concession from the seller.
Perfect. Good to know. Thank you.
Thank you.
All right. I think we can move on to our next question. So how to calculate buy downs? This is a very popular question. How do you arrive at the payment? Can you show us some examples? I believe this is geared toward Chris.
All right. Yeah. And we've got a couple of, the lender that you work with if they're doing buy downs, they should have some tools. And so we at Newrez have a calculator, as does PRMG. We've got both of those here on this screen. In fact, we've got a newer one as well that includes 321. We just rolled out a 1.5% buy down, as well as the 2.1 and the 1.0 that you see here. But it's essentially what these calculators are doing is putting together, let's say again, in this example, a 6.5% is the note rate. And we'll look at the 2.1 buy down as our example. If you look at the Newrez example on the left, just because that's the calculator I'm most familiar with, the interest rate being 4.5%. The full payment on the note is $3,160, but the payment at the discounted rate of 4.5% is $2,533, where the difference is $626.91 a month over 12 months. The subsidy amount for that first year is $7,522.92. That kind of just there on the right side of that grid under Newrez. Did the same calculation at 5.5%. The total of that subsidized payment for the first year is $3,800 and change. So the cost of a 2.1 buy down is basically the difference between those discounted payments and the full note rate payment. So the total over those 2 years is $11,379. That is what the seller would pay for the buy down at closing. So that's how you calculate it, and then that money is put aside as in a custodial account for the borrower. So when they make their payments, the difference, the delta between in this example, let's say the first year 4.5% and 6.5%, that the borrower makes $22,533 payment, and then they take $626 out of the custodial account and put those together and then forward that on to the investor as part of the securitization.
So Chris, these calculators look pretty important up front for originators to be using to be able to calculate, work with a realtor or seller on the amount
Right.
that may be needed, right? So this is not something you do when you're ready to send it to underwriting, figure out, what kind of seller credit to throw in there. Maybe not that it can't be done further on down in the process, right?
Right.
Before closing, but these calculators are pretty crucial to kind of help figure out if your borrower has a comfort level of a certain payment, where would that rate need to be, and how much of a seller credit
Right.
really is going to be.
And then actually communicate that to the agent, right? To say, hey, we're talking about doing a 2.1 buy down or whatever type of buy down you're trying to do. This is the amount of a credit we need from the seller in order to make this work. So when they're writing up the agent's writing up the contract, you've got that, and you could even show them. So we actually have, you could see, it says Newrez at the top, but we have non-branded versions of this as well, so that our broker partners can put their own branding on the worksheet, and so that they can show it to their realtors with their own branding.
That's very cool.
And
Yeah, I think this is really important to be able to see and utilize. They don't look very complicated, but from a borrower standpoint, to be able to see exactly where that money goes and how it's applied, and then really what are they getting from the seller, dollar for dollar for that negotiation is pretty powerful to show them up front.
And a shameless plug for ARIVE. We just launched a broker branded version very recently. So we work with our lender partners like Newrez and PRMG and put everything at the front end. So you can generate these flyers and like the panel said, educate the real estate agents and the borrowers on its benefits.
Fantastic. Okay, and so our next question for our panelists is, how are the buy down funds used? So if they were to pay off the loan in the first couple of years and these funds are not used fully, I know a lot of borrowers are going, okay, great. So I buy down my rate and we negotiate all this, but what if I want to refinance in a year? What if I sell the house in 2 years? What happens with these funds?
Yeah, that's probably the most popular question I get asked about buy downs. It is your funds. I mean, the seller is making this contribution, and Chris alluded to, it is being held by the servicer in a custodial account. So if the home is either sold or if you decide to refinance, that money is going to be allocated and it's going to reduce your principal balance of your loan. So it's still your money. So whether it's being allocated on a monthly basis to give you the lower payment, or or if it's paid off or refinanced, it's still your funds and it lowers your principal balance. So all good stuff. It's positive, either payment or lower balance.
Yeah, and yeah, a good point with that too is, sometimes people ask, why wouldn't I just do a permanent discount, right? With the seller's funds and just buy down the rate permanently. That's one advantage that the temporary buy down has over a permanent buy down, is that that money is sitting in the borrower's account in a custodial account, and will reduce the payoff if they pay that loan off within the subsidized period of time. Whereas with just paying discount points, that money's gone at closing, right? That's a fee that goes to the lender, and doesn't matter if you pay that loan off in 6 months. That money is gone at that point. And if you're someone that believes that interest rates in the next year or 2 years are going to be lower than what they are today, that even more greatly supports the idea of doing a temporary buy down versus a permanent buy down.
Wonderful. So it's really not a use it or lose it. You get these funds no matter what. They're applied toward the payoff, which is huge for borrowers to understand. Wonderful. And Harish, I think we have one last question before we kind of get into our Q&A from our attendees. So how do we market buy downs to our buyers, our real estate agents? And I would like to kind of change this question a little bit. Builders, I mean, yes, builders love this buy down. They've been asking for it even before the lenders really were able to kind of reprogram it into their system. When are buy downs coming back? So maybe if you each can kind of touch on, how can our originators market this? How do they approach agents? And we've talked about, co-branded flyers and tools. But if we can also kind of touch on why are builders using this product, and why is it important to them as well?
Yeah, for sure. I mean, other than the tools that we just showed you guys, I mean, if your competition is out there and they're selling it, you definitely want to be, on the same level as other brokers that are fighting for that builder developer business. And I think a lot of the times in the rising rate environment that we're in, and Chris alluded to this at the very beginning of, the reason why buy downs are popular, it's nothing new. This is not a new, program or something new to our industry. It just wasn't relevant when, rates were low and we were in a, in a seller's market. So now that all that has changed, those two factors have completely flipped on us. Buy downs are back and in play again. But, these builders look for any way that they can make a payment less for a borrower. Even though they are qualifying at that fully index or the full note rate, if that payment is more attractive and they can show a lower monthly payment to a borrower, then yeah, why would that builder not want to work with you, the broker who's offering this, compared to the broker down the street that has no idea what a buy down is? So it's just one more, one more thing to arm yourself with to go out there and sell. And if you become the expert in buy downs, as long as how to sell it and what the requirements are, it'll set you apart. And I really do believe that it's something strong, especially given the current rate environment, rising rate environment that we're in.
And Amy, talking about builders specifically, obviously real estate agents and sellers see the benefit of this. Real estate agents, let's face it, their commission is based on the sales price, right? So if there's an opportunity to do something other than lower the sales price, they're going to do that. Plus that, that sale that they're doing right now is the comp for the next sale they've got coming after it, right? So they this will help maybe soften the landing of some of the decreases in sales prices that we've seen recently in a lot of markets. And then for builders are extra sensitive to that because builders are selling homes in a specific community, right? So they've got a certain number of homes in a particular set condensed area, and they've got contracts that sit out there for a period of time. And builders have been faced with a lot of cancellations recently as prices have gone down. And so a product like this that can help stabilize prices a little bit, where you're offering these incentives instead of lowering the sales price, or maybe just lowering the sales price less than you otherwise would, is a huge benefit to a builder, because if they've got to cut prices deeply and have contracts on, let's say, the same model already out there at X, and then they've got to sell the next house, which looks exactly the same in the same area for X minus something, it's going to cause problems with those contracts they already have out there with other buyers. So if they can do more incentives like this, builders really love temporary buy downs. Yeah, it definitely helps them a lot.
And Chris, builder concessions are nothing new. It's just now they can gear their concessions towards actually lowering the monthly payment to the future homeowner. That's huge. So
yeah, it's probably builders' favorite thing ever is buy downs, right? Because they have the advantage, they are the seller, so they know going in already how to negotiate, how much money is needed, so they can really package it and make their home sale really affordable and attractive to buyers. So if you are working with builders, definitely work with them on the buy down options, and be their advocate and their resource for these products. It's pretty powerful. Well, this has been fantastic. We have a lot of questions. So I want to thank you guys so much before we get through here, Cory and Chris, for joining us. If there's any questions we do not cover, please reach out to them directly for specific questions. We're going to try to cover as much as we can here on this call, but definitely reach out to them. They can put you in touch with an AE in your area who can help you with all of these products and more. Okay, so Harish, if you don't mind, I'll jump into a couple of these questions, and then if either of you want to jump on it or help us answer, that would be great. So one of the questions is, can you do a temporary buy down on a second home and investment property?
no, primary. So it's an owner occupied primary occupancy that allows these buy downs.
Okay, perfect. Thank you. Another guest, thank you, Ben, has asked, can one do a buy down and seller contribution towards the closing costs at the same time? Do both have to be within SC caps per LTV?
Yes. Yeah, you do. So you can do both, but it does have to fit in with your interested party contributions for that product. So right. So depending on what type of loan you're doing, whether it's FHA, VA, or conventional is based more on loan to value. Just know whatever loan you're doing, the temporary buy down cost that the seller's paying has to fit within those interested party contributions.
Okay, good point. Okay, another question came in. If a buy down agreement is signed at closing, is it necessary that the seller knows their concession is going toward a temporary buy down, or if it doesn't matter if they know, as long as they've agreed to it and offer concessions to make the deal happen?
Chris, you want to take that one? I don't think it matters.
Yeah, I'm not aware of any
I don't think it matters. I
stipulation.
think, just what Chris alluded to, and you brought up a great point because we didn't touch on it yet, but these all have to fit within the program's allowable concessions. Right. But it shouldn't matter. I mean, if the seller is giving a concession of X and that borrower is choosing to use it towards a buy down, closing costs, etc., it's fine. It shouldn't matter. And the seller should really have.
It will show up on the CD as a temporary buy down subsidy, right? Temporary buy down fee. Yeah.
So I guess the seller, when signing their part of the docs, might see it there, but it shouldn't matter either way.
Okay, great. A couple of people have kind of asked the same question a few different ways. So who can contribute to the buy down? Is it just the seller? Can anyone else? Is this an overlay question? What are the what are the contributing factors to
yeah.
maybe why others cannot?
Each lender might be a little bit different in this. I could tell you with us, it's going to be all the seller. And that's really the only time it makes sense. Sometimes we get questions, hey, can the agent also contribute to it? And systematically, we don't do that. It's all the seller, but there's ways you can, you can still have the seller pay it and then the agent lower their commission a little bit and ends up netting the exact same thing to the seller at the end of the day. So short answer is it's all the seller, at least for us.
Yeah, I agree. Us too. And
Yeah.
I still think there's a lot of, internal compliance at various different lenders that are still kind of unpacking this, but yes, for right now, it's seller paid.
Yeah, and so you will see some others, come up with, I get people asking, hey, can the buyer pay any of this? Or pay, it makes zero sense for a buyer to pay the temporary buy down fee because all they're doing is making their part of their mortgage payment before they need to. Makes zero sense at all. So I wouldn't even entertain that discussion. Some lenders have a lender paid buy down where they're paying it through, we do not do this, but through yield spread premium. And again, the buyer is now paying it through a higher end interest rate, right, final note rate to do it that way. There's a reason why, and that's something, if that works for the borrower, that works for the borrower, but there's a reason why temporary buy downs were not popular until we got into a buyer's market where sellers were going to give concessions, because it makes the most sense when the seller is paying the fee.
Makes sense.
Thanks.
Okay. Are there any prepayment penalties on a program like this? Sounds like this is just normal underwriting guidelines, and then we're using seller funds to help buy down the interest rate, right? As a dollar figure.
Yeah, there's no prepayment penalty. The only thing is a broker is you always want to be cautious of your early payoff penalties. And talk to your lender as to what that period of time is.
Okay, perfect. Someone asked, can we remind everybody, where do they reflect this on the LE and CD? I know we touched on that a little bit, but if we can kind of talk about from an originator standpoint, where do they have to be cognizant of showing this? And then where is it shown, I guess, at closing?
It's going to show up in section H on the LE and the CD. And it's going to show the seller contribution to buy down is going to be the amount that's shown there. So not until you get to the closing table do you actually sign the buy down agreement. But until then, it's going to show up on section H of the LE and the CD.
Yeah. So the LE, the first page of the LE will still show the note rate payment on there. And I know that's sometimes confusing to a buyer, and we've checked with the CFPB as to how it's supposed to show, and they've confirmed that when this, a seller paid buy down still needs to show the rate that's on the note itself on page 1 of the LE. So that's what we do. There's a temporary buy down fee in section A, and then the subsidy being paid in section H, as Cory said. So I know that sometimes that's a little bit confusing. So you got to, talk your borrowers through that. And we've explored the idea of having that temporary buy down agreement that we issue at closing to have something similar, so at least something informational that we could show in the upfront disclosures.
Okay, perfect. And then I think this is kind of a common question. Maybe we can just address, what's the advantage of doing a temporary buy down versus just using seller credit to buy down the rate? For example, if the seller is giving a 3% concession towards the buyer's closing costs, why not buy down the rate with 3 points for the whole loan term?
Yeah, so I alluded to that in a little bit ago. The biggest advantage, there's a couple of advantages. So the first one being that when you're doing a temporary buy down, that seller credit is now the borrower's money, even if they pay the loan off early. And it's not the borrower's money in it if you do, pay discount points, right? That money's gone once you've paid the discount points. So you've got that, kind of in your back pocket as a buyer, if you do the temporary buy down and you end up paying it off early. The other advantage is, right, obviously you're going to get a steeper reduction in interest rate and therefore payment in the first, year or 2 years if you do the temporary buy down. And if you're someone that thinks that interest rates are kind of at its highest level, maybe right now, and they're going to be at some point in the next year or 2 years going to be lower than they are today, and there's a refinance opportunity for that buyer to get into a lower, longer term 30-year fixed rate, then that's a reason as well to do a temporary buy down.
Great answer. Okay, and I think we have one more question here. So in most cases, buyers won't have their first mortgage payment for 1 to 2 months after they close. So does the buy down period start at closing or at the time of their first mortgage payment? Meaning, is there a time frame?
The first mortgage payment is going to be paying the interest from, from arrears, right? From the previous month. So it starts right away. It starts from that first payment. Well, it starts from closing right through that first payment.
Definitely.
Yep.
And there's some questions coming in that just kind of like specific scenarios on, why this would work for somebody. And I think it's important to just note that buy downs are not for everybody. This is a very specific type of loan, and it's going to work for certain borrowers on certain homes with certain sellers. And so this is definitely, not a one for all fit all type product. It's something that you just want to be educated about, know about, how to speak about with your realtor partners and your buyers so you can be the most value to them. And sometimes it's going to be the best option, and sometimes it's not going to work on that particular property. But I think it's just important to note that it's a valuable product that's out there, and to reach out to your lenders.
And it is growing quite a bit too, right? Because it is something that we've had for a long time, but we haven't paid any attention to. So when we first kind of woke up to the idea of buy downs being timely right now was probably late spring, as interest rates were rising rapidly. And, we started looking at, okay, what can we do to add to these, to buy downs? Can we put them on more products? We made them available, not just on conventional and the Govy products, but also on our non-QM products. So our Newrez's non-QM suite of products is called Smart Series, and we've got 3-2-1, 2-1, 1.5, half, 1-0 buy downs, all available on non-QM as well. So what you've seen is really, hey, we've taken this old product, dusted it off, and then really added to it and expanded the type of products and the type of buy down periods that you have available as well.
Flexibility and options are everything, especially since every little dollar sales concession counts. We want to be able to use those to our borrowers' advantage. So great. I think we've covered most of the questions. Harish, there's a lot of chatter about showing how the buy downs work in ARIVE. So maybe we can get something out to our ARIVE users specifically about how the buy down works in ARIVE. We can create a little video for you and share it to our users, because it is a very cool tool and we want you to be able to use this product as soon as possible.
Yeah, absolutely. So we did a training last week on buy downs in ARIVE. How do you set them up? If you're a non-Del, you can also do docs through ARIVE. So, there are a lot of questions about what goes on LE and CD and buy down agreements. So that is all live in ARIVE. If you're a non-Del broker, you can actually push docs, not just structure buy downs in ARIVE. So again, we have office hours happening every week. You're welcome to join that. And we'll also put together a special tutorial on structuring buy downs in ARIVE. So thank you, Amy, for that. So I'm going to mark all those questions answered. There's one more question, which maybe like in terms of compliance, are there any suggestions if brokers want to market buy downs? Should they be worried about how should they market this from a compliance perspective? That's a great question, Manny. So any thoughts,
Yeah,
Chris?
sure. I'm sorry. Go ahead, Cory.
I mean, there shouldn't really be any, since the seller is paying for it and it's coming out as a concession, that cost is pretty much dollar for dollar going to be negated. You're still going to have to pass QAM and high cost and run all your normal tests that you would with any other loan. But I mean, there shouldn't be anything other than, the seller paying for it that the loan can't pass compliance.
Right. And make sure you're marketing the note rate, right? And if you're if you're doing, that same example we used, 6.5%, you can't go out and say, hey, I got a 4.5% loan and market it as a 4.5% loan. It truly is a 6.5% loan. The APR you disclose is also based on 6.5%, the final note rate. So you just have to, do that. Make sure that you're clear in your marketing as to what the actual note rate is.
Good point. Chris, we have a question on your non-QM product. Is that also just for primary residence as well?
It is, yeah. You cannot do any investment properties on the non-QM. So our products that you can do it on would be our Smart Self, which is our bank statement product, and Smart Edge, which is our full doc non-QM product. And those are actually, we're getting a lot of really good feedback on that, because a lot of times on non-QM products, right, you're not talking about 6.5% rates, you're talking about 8.5% interest rates in some cases. And so if you can, make your borrower, obviously they're qualifying at the final note rate, but if you can make them comfortable with, let's say you're going to do a 3-2-1 buy down. So you got 5.5% the first year, 6.5% the second year. Then, or I'm sorry, 6.5%, 7.5%, then 8.5% in the final year. In that example, then it can make it a little bit more palatable. And then there's also, the benefit if you think rates are going to be going down anytime in the next couple of years, the opportunity to refinance then into a 30-year fixed at a lower rate.
Right. Or even maybe a borrower who's non-QM temporarily, but maybe in another year or two, a couple of tax returns filed, they may no longer be a non-QM.
Right. File a couple of tax returns over the next couple of years that help you qualify for a full doc loan. Sure.
Definitely. Fantastic. Is there any other questions, Harish, you see we want to address?
Yeah, I think there's one interesting question, which I'll let the panel answer. How about prepaid interest? Is that calculated on the note rate or the buy down rate, the prepaid interest?
So the prepaid interest at closing?
Yes,
I see
it is calculated at note rate.
Yeah.
So just letting.
So they've got the 11 days,
11 days,
whatever, through the end of closing. I'll have to double check that, but I would think that that's going to be based on the note rate, because those X number of days are not included in the buy down subsidy. So that might be something we have to take back to confirm.
So I can confirm that. So yes, I mean, so yes, it is calculated at the note rate, whatever 10, 15 days, and just exactly like you said, Chris. So for the first payment, when that is made, that's when the funds start kicking in. So but generally that's really small, you're looking at 10, 11, 12 days. So
yeah, you're probably talking about a difference of a few dollars.
Right?
Yeah.
But yeah, thank you. Let's see, Amy, anything else you see? I think we have many questions on, lowering the price of property, all that. So I think Chris did go into great details. Anything else, Chris, you would like to, add to that? Like, why not drop the price of property and all that? I think that's kind of how you showed from dollars, buy downs are much beneficial. And anything else you would like to add to that?
Yeah, I mean, I think being able to, being comfortable with the calculator. And like I said, sounds like you've got a calculator in ARIVE that originators can use. Newrez and PRMG, we've got calculators as well that if you want them, talk to your account executive to get copies of those. So being comfortable running those and talking with your agents about the cost of the buy down when they're negotiating a contract, I think is really important. And then also being able to then explain, like we did, the difference between, the benefit of doing the buy down to the buyer as opposed to doing a dollar for dollar price reduction. And then the benefit to, obviously the benefit to the buyer And then the fact that it actually makes no difference to the seller as far as what they're going to end up netting at closing. And obviously there's a benefit to the agents because their commission is based off of the sales price. And of course, the benefits to builders that we talked about as well.
All right. So this is amazing. This looks like a win-win situation for all parties involved. So
It's perfect for this market that we're in, right? There's times where buydowns will be irrelevant, like we saw for a long time, but there's times where buydowns are perfect. And right now is that time.
all right, Cory, you have any final thoughts before this was a great, any final thoughts you would like to mention as we close this down?
No, I mean, it just pretty much everything that we've already touched on. I mean, it checks the two boxes that have occurred recently, and that's rising rates and, sellers willing to contribute. So that's what's needed for buydowns to work. And it is a win-win. You guys utilize the tool. I mean, everybody's got calculators, whether it's the specific lender, PRMG, Newrez, or you want to use ARIVEs and brand it yourself. Put that in front of the borrowers. Let them see the actual savings that they see year over year, because payments is what you got to sell in a rising rate environment. It might not be rate anymore that we're taking to these borrowers. It's necessarily the payment that we're showing them, and this is a great tool to show them a lower payment on a month-to-month basis and year to year.
And these are great borrowers to keep in touch with, right? As rates go down and you're outside of your prepayment penalty, these are borrowers to reach back to and maybe offer them a refinance opportunity at a lower rate. So it really is a win-win for everyone. I agree.
So, all right, with this, I again want to thank Chris and Cory, both of you, for taking your time to talk about a very timely topic. The recording of this webinar will be available on our support website later this week. So keep an eye for that. But again, thank you, Amy. Thank you, everyone, for joining today. I appreciate that.
Thank you,
so
guys.
much.
All right. Thank you. It's been
ARIVE.
fun.
Appreciate it.